Welcome everybody to these results, which are the audited results through the end of March this year of our financial year. First of all, I want to start with the rest of the world revenue, which was growing very, very nicely at 15%. That is revenue excluding China and Japan. In addition, a smaller part of our portfolio outside of the Avlacin range is our anti-parasitic portfolio, which also showed very good growth at 31%. Slightly smaller part of the portfolio, but those were two of the positive drivers. The whole of the world, excluding China and Japan, growing 15%, and decent and nice growth out of the anti-parasitics. So the other highlight I want to emphasize is the growth drivers there are positive in most major markets, and that is because of the intrinsic value that the portfolio delivers to producers. So that is a low dose, highly effective, unique veterinary-only anti-infective, which provides excellent control for respiratory and enteric disease in swine and poultry. To support our global position, we have a wide range of marketing authorizations, well over 100 in all the major producing countries. And we did add to those marketing authorizations this year. Notable Avlacin water-soluble marketing authorizations, including in China. And we did launch biologicals, that's vaccines, in Brazil from our partner company. These are not our own vaccines. These are our partner vaccines from Farmgate in the US. And we just started that towards the end of the year. Less material in revenue, but very important from a strategic point of view. And we're just starting getting our feet wet with the vaccine market in swine in Brazil there, but a nice strategic move. Next slide, please, Hannah.
Thank you, David. I'll pick up the next few slides, and we'll work through some of the financial highlights from the results. Results are available online. Any further detail is available within the document. Clearly, the headline of sales this year is a lower figure, and that we'll see is very much a China effect. And we make no excuses for mentioning the non-China growth once again. David mentioned it in his opening remarks, and I mention it again. A reminder that 2/3 of the group's business this year, revenue this year, was derived from markets outside of China and Japan. The segment we call China and Japan, but for these purposes and for many of the remarks through this presentation, you should read China. Japan really represents only a couple of £1 million of revenue, so this segment is all about China. So the emphasis is there that outside of China, the group continued to grow 15% this year. You'll see if you've looked at the results for Eco over the years, most years it's exhibited double-digit growth. Low double-digit is what we guide to, and that is a product of the continuing and accelerating market presence of Avlacin, our main product. It is gaining market share every year, and it's gaining new authorizations and entering new markets. That drives that growth path. It's the historic trend, and we see no reason why that trend won't continue. Gross margin was the other headline number this year, which was a reduction compared with last year. As we'll see later on in the presentation, that again is a China effect. And to give you an indicator of what that's all about, it's geographical mix. So China historically is a high margin geography for us, where China represents a high proportion of our business, clearly that improves overall group margins. Conversely, when China represents a lower proportion of business, that reduces group margins. We'll see that again later on. EBITDA is a consequence of the reduction in revenue, sales revenue. We'll see in just a moment as we flip over the slide that our cost base is a very fixed cost base in overhead terms. Hannah, if you wouldn't mind moving on, please. So cash overheads is indeed fixed, just as I've indicated. In fact, when we come to it in a few slides' time, we'll see that there was a £500,000 reduction in cash overheads. So as I've just said, top line reduction results in bottom line reduction. It drops straight through to earnings. And that's seen in the earnings per share figure. Nevertheless, having said all that about reduction in group revenue, we have continued our investment in new product development this year. We've kept it at the planned rate, which is £10.2 million of cash expenditure this year, an increase from prior year, and actually expressed as a percentage of revenue at 12%. This is towards the top end of what you see in this in the animal health and in fact in life sciences generally. So that's at a particularly high level this year. We've seen some very important new product developments and progression, and we'll talk more about, in particular, our two advanced poultry vaccine projects, which are entering final phase. So that is the main driver around keeping the new product development expenditure going this year. Cash expenditure, or sorry, cash balance at 14.3 is a reduction compared to prior year at 19.5. Having said that, again, we'll see that later on. Pro formaing out the minority interest cash in our China JV gives you a more consistent balance of cash year on year. So turning to revenues, there's a couple of charts here, both on this slide and the two that follow, which describe what's happening in the revenue stream. And we've presented these over 4 years. This is to try to show that 2021 was, in many respects, an anomalous year. We reported record revenues last year, and when you see it in the context of 4 years, you see that it's anomalous. There is an underlying trend there, which I indicated was that low double-digit growth year on year, and you see it both in group terms. You see it certainly in rest of world revenue, and actually you can detect it within China and Japan. If we look at the China and Japan bars, the bar chart, that really is the story of African swine fever as it moved through that country. In 2019, it first emerged. It really didn't affect our revenue that year until 2020, when the massive culling of the herd, and most analysts will now say that half of the herd in China were killed during that period. And so less animals, less market for us to address, and therefore we had a reduction in revenue in 2020. That resulted in a shortage of supply and an incredible period of reinvestment, restocking, and some of the major players within China really used all means to increase their herd numbers, both at sow level as well as pigs in production. And we saw the major companies accessing equity, in particular accessing a lot of debt as well, to grow their facilities, grow their production. And that resulted in 2021 in an overshoot, an oversupply into the market. The consequence of that, together with the lockdown actions around COVID in China, actually put the supply demand equation out of balance again, and we ended up with a pork price which descended to a level where those major producers in particular were making a loss per pig produced, and that really was the story around 2022. In more recent times, and we've got a graph later on which will show this, we can see that the indicators are turning positive for the future in China. We'll address that later on. Next slide, please, Hannah. Thank you very much. It's stepping down one level from that broad brush into the sectors we report. We've already spoken about China and Japan, which clearly dominates the image. Having said that, I'll draw your attention to the trend line in North America, South and Southeast Asia, Latin America. These are some really important regional geographies for us, made up of a number of countries, but you see that consistency of growth year on year. To answer the question of why South and Southeast Asia shows a high bar in 2020, that was a specific appointment of a new distributor in India for the poultry market. There was a £5 million order that year, or series of orders, as they stocked up, and that was what skewed that year. But nevertheless, you can see even within that geography, you see the consistency of growth. Europe is a small, relative to the other geographies, small region for us. These are a basket of countries, as we all know, and they're really a mature set of markets in swine and poultry. We haven't seen in the past any particular growth in Europe that we would talk about, and in this last year we had the revenue in Europe slightly hampered by supply issues. Those issues, those constraints have been corrected in this current financial year. So we'll see some modest growth coming through in Europe in this coming year. But really, I'd guide you to understand that Europe is a mature set of markets, and will only really be really set alight when we introduce our vaccine products into those markets, and that is some couple of years down the road from now. And the next slide, please. This slide is, and my apologies, it's a fairly busy slide, but what this seeks to show is the first half, second half weighting in the group. And so each pair of coloured bars represents the first half revenue compared with the second half revenue over 4 years. And what you see, if you glance across, is that in most markets, in most years, we have a second half weighting to the business. There is a reason for that, aside from the classical human reason of it represents our year end, and therefore you always have the run up to the year end effect. But more importantly, and more structural, if you will, most of our markets are Northern Hemisphere markets. The Northern Hemisphere has its winter within our second half. And avicin is a product which is used to treat, in the main, respiratory illness in pigs. Pigs, rather like humans, suffer from winter germs, and this is the effect coming through here. But the reason for presenting this is not necessarily to emphasize second half weighting, it's to highlight what's going on in China. And you can see the second half of the year ended March 2021, being that dark blue bar, was by any measure a record period of trading. And since then, each successive 6 months of trading has reduced to the point where, we actually had a lower second half in the year ended March 22 compared with the first half, which is the first time we've seen that. Indeed, that softness of trading that we saw in the last 6 months continued into the current financial year. And that has informed our comments in the outlook statement, which is a cautious stance on China. And we will see that as we work through and towards our interim reporting at for the period that ends at the end of September, releasing that during late November. Hannah, please. So that's revenue. I spoke earlier about gross margins, and what these pair of charts show is to demonstrate that really the margin movement we saw in the year was really all about geographical mix rather than cost inflation or discounting, sales price discounting. And to demonstrate the point, you've got the gross margins on the left, and on the right, those same gross margins put alongside bars which show the proportion of the group's revenue represented by China. Clearly, in a year such as 2021, where China was 56% of the group revenue, we had a high margin. We had over 50% gross margin. Conversely, such as the last year, where China revenue fell to a third of the group's revenue, the margin reduced. And the correlation is true there for previous periods. So I guide you to understand that the group's margin is really about mix. China's margin is around about mid-50s%. It is amongst the highest of the group's margins. Only higher than that is typically Canada. And that is contrasted with countries such as Brazil, where the margin is half that of Canada. So you can see that the mix effect has quite an impact. That's not to say that that we shouldn't consider cost, and we managed to put through a price increase in most of our markets during January 2022, which helped to defray any cost inflation during this final quarter that we reported this time. And of course, we will consider price increases as we go forward and as necessary to offset any cost inflation that we see coming through, which I think all of us can now expect will be a feature of the next year or two. So I mentioned earlier on that we kept the expenditure going in R&D. This is a very important growth driver for the future. We've spoken more and more about this over the last few years. In particular, we lifted the covers on it during our Capital Markets Day in January. And the fruits of the labor are really starting to become near at hand. We can see in a little over a year's time the first of the home-built vaccine programs delivering a regulatory approval. And hence, it's really quite exciting to get to that commercialization stage. And so the reason for the fairly heavy investment. 1.4 million was the amount capitalized in this last year. That represents expenditure on these final stage 2 poultry vaccine projects. They will speak more about that later on. The 8.8 is then spread across a range of other projects. And like a good portfolio, it contains every element of the range of risk and reward. So we have some early stage projects in there, which are tackling some fairly groundbreaking biologicals and vaccine technologies, and could potentially be really quite transformative, through to some later stage programs, which are more well understood technologies and established markets. So you've got risk and reward, which spans and gives us a good portfolio effect. So the next slide is just showing the admin expenses, again spread over 4 years, to show you how that has progressed year on year. We had a major step up in investments in the group infrastructure, if you like, which is what overheads represents. Major step up in 2021 by about £5 million, and then it's been constant this last year. In cash terms, a reduction of £500,000 is a reduction in bonuses. Bonuses are associated with profitability of the group, clearly lower profitability, lower bonus provisions. The increase in non-cash is really non-cash things like depreciation, amortization, and share-based payments, which is a charge based on a Monte Carlo modeling of the likely outcome from share options and LTIPs. As a result of the LTIP issue last year, that charge went up in this last year. In this next slide, I've attempted to, I'm not sure how successfully, but I've attempted to bridge our profitability through the record year last year and into this year. So accepting that last year was anomalous in many respects, we started with profitability EBITDA of 8.3 million in the year end March 2020. And as we reported last year, the reason for the major increase in profitability last year was revenue driven, gross margin driven, both China effects. Turning to this year, we had the converse. So China softened, we had a revenue reduction and a gross margin reduction. So Those are two primary moving elements. I mentioned on the previous slide the admin expenditure increase in the year ended March 21. You see that as the 5 million increase there in the middle of the chart. So dealing with all of those, what does that leave you with? You've got R&D, where last year, so in year ended March 21, we reduced our R&D expenditure by 0.7 million compared with the prior period. In this year, we increased it by 0.7 million compared to March 21. So those two are a mirror image of each other. And then finally, to complete the bridge, we had a foreign exchange loss as part of our profitability in the year ended March 21, and a foreign exchange gain this year to take us to 6.4 million pounds. I hope that sort of brings the P&L to life. So turning to the balance sheet, we have a balance sheet which is we're relatively capital unintensive as a business. Our business model is a very outsourced model. So we don't, aside from in China, we really don't run factories or big laboratories. So really the balance sheet is dominated by working capital movements and working capital numbers. Inventories at 30 million pounds is a 10 million increase compared to the prior period. And that was directly associated, it was deliberate, it was planned, directly associated with the planned shutdown of our China factory for 6 months. In China, we take the raw ingredient and we process it into finished goods, into finished avicen. And that factory, having been in a particular configuration for about 10 years, had to change. There were new regulatory requirements around greater automation. And so our joint venture partner has built a brand new building for us, a brand new factory. The joint venture is equipping it as we speak, and will be back on stream with full production from November. So in anticipation of that shutdown, we grew the inventory holding going into the year end, and that is serving us with our trade through the summer months. Receivables days are very pleasing that they are consistent year on year, and that's really where we aim to try and manage the cash tied up. I mentioned right at the opening remarks about cash, and we need to look through this apparent reduction in cash of 5 million pounds to look at the cash actually owned by the group. We have a joint venture in China, which is 51% eco-owned, 49% minority. And the repatriation mechanism for cash from China is a dividend. So when you declare a dividend, clearly you lose half that dividend to the minority. So in some respects, we portray cash as that cash that's owned by the group and that which is really belonging to the minority. When you pro forma that out, it's in that call out box there, cash excluding minority interest, which is reasonably consistent year on year. You can see that over the last 3 years. Thank you, Hannah. Cash flow is the other side of the balance sheet. You see the same comments I've made earlier on the balance sheet coming through in cash, so an increase in inventories, and the capex for the new China factory there. The rest of the capex the China factory will see coming through in this current year. So this current year ended March 23 will be a slightly more capital intensive year than we've seen in eco historically. And then from 2024 onwards, it will revert back to its historical level of cash expenditure. We see fairly heavy tax payments in this cash flow statement, and that is because of the very strong profits in China in last year, and this is the tax paid as a result of that, as well as some withholding taxes on dividends and royalties which were repatriated to the UK from China during the year. Final slide from me, Hannah, is coming up, and that is really to wrap a number of other elements into one slide, which you'll see as features of our annual report. First, and most obvious, is that we are late in reporting this year. we had intended to report during July, and we're now, it's taken all of August to complete the exercise. And the reason for that was the audit itself was a fairly extended process. A number of reasons for that. The first of which is a more intensive inquiry into intangible assets. Intangible assets are the capitalization of R&D. And this was the first year in which we were actually capitalizing some vaccine work. This is a step out from historically where we've really undertaken all our R&D in around Avison. And clearly when we move into the vaccine space, there is a question as to, are these projects actually going to result in commercial products? So the auditors did a very extensive inquiry, including conversations with expert witnesses, which we put before them, looking at cash flows for the expected products, as well as looking at the costs themselves and the separability to ensure that all of what we're talking about is meeting the requirements of the relevant standard, but also fundamentally, have we got the right high confidence level around a successful commercial product from these programs? And all of that passed muster. It was validating the model, it was validating what we were doing. And we see that as a positive. Painful at the time, but positive as a result of that ticking box. There were some other elements which needed to be addressed, and that was what resulted in the prior year adjustment. So this comment and the third point are linked. We identified during the course of the audit, not as a result of the audit, but during the course of the audit, that one of our foreign subsidiaries could potentially have a need to settle some unpaid tax, which behaves rather like a sales tax. It's not a sales tax, but it behaves a bit like VAT. And it's a highly debatable tax, and one which is being challenged by a number of animal health companies in that market. We took advice from a number of world leaders around tax, both in country and geographically world leaders. So I'm referring here to PwC, have been helping us on this. And the advice we've received is that we have a good defense for our position on this. Having said that, it has been challenged by a number of other peers, and it's been found that this tax is payable. So with that in mind, we took the prudent view that we should provide for a probable settlement. And so that's what you see in the accounts. We've matched that against the years to which it would relate. And suffice to say that there is a 5-year statute of limitations around this tax item. So it's a 5-year item, and that's a rolling 5-year item. So that's what you see appearing in the accounts as the prior year adjustment. I mentioned here that the audit report was qualified. This is not a new qualification. If you look at prior year annual reports, the same qualification appeared, and it arose in March 2020 when the auditors were not able to visit a few of the group's warehouses to attend stocktake. This was a week or two into the COVID-19 lockdown, and the physical presence was not allowed. So that resulted in an audit report qualification in the year end of March 2020 and in the year end of March 21, and it reappears this year for the final time. The reason it is this year is because it represents the opening stock position for the comparative year in our reporting. So that's the last year that will appear. And then the final comment here is that we have embraced the principles of ESG. we set out a good report in the annual report in where we're taking the group's approach to ESG. And this year was very much about establishing the baseline for the ESG journey. And I say that ESG is not a destination, it's a journey of improvement. And that is certainly the way ECO has considered it and has started that journey this year.
Thank you, Chris. So I'd like to give you a little bit of insight and line of sight to what's happening in China. So the graph on the left-hand side, the top dark line, shows the profitability of pig farming. And you can see a pretty rapid decline in 2021 that was affecting most of the year that we are reporting now. As you come into 2022, you see that in the latter part of this year, pig producers across China are back into profitability. That's what the top line is showing. The bottom red line is showing a ratio that is useful to think about in terms of pig production. Feed is 70% of the cost of production. So your cost of feed, as it is related to the cost of your product, which in this case is pork, is a very useful indicator of profitability. And if that ratio is around about 5, that is a good indicator of profitability. And we've got back to, or China has got back to, having that indicator of feed to pork price being above 5, which is the first time that's been there for a year. So the other good point about inventory and the future market as we go forward is all 3 of the large pork producing markets around the world have seen a reduction in their sow numbers, which means the supply side of pork is reducing in those major areas, US, EU and China, and all 3 are in sync in terms of that reduction of inventory. The demand is increasing for pork. There's more people in the world, more people wanting to eat high quality, particularly white meat, poultry, and in this case, pork. So with the demand solid and the supply side coming down, that is a good future indicator for pork price and our customers, our pig producers' profitability. Top left graph really just reflects that. It overlays the feed to pork price ratio with our revenue. And you see when that ratio is higher, our revenues are equally high, because in essence, when the pork producers are making money, they've got valuable stock, they want to protect their stock by using quality medicines that give a rapid return to health. So this is showing good trends, that the pork price is positive. The future trends of supply and demand look also good, and so this is a useful position to be going forward in. In essence, the summary is that we will be trading in more favorable market conditions as we go forward. Next slide, please. Now I want to give you a little bit of an R&D update. I joined the company in early April, and one of the reasons that I joined was I was excited about where ECO was on its journey and excited about the R&D pipeline. And I'm glad to say that as I've looked into that, I have found great value in that pipeline. Remember, what we are doing here, as we've said before and was done by the company in the Capital Markets Day in January, is that we are focusing our R&D on the preventative treatment of major diseases in pigs and poultry, the diseases that cause major economic damage to those industries. And we've got a great range of different maturity in that pipeline. So we've got some early stage, some mid stage, and some late stage projects. We've also got a balance within the portfolio of different sizes of project, and we've got a balance across the 2 species of swine and poultry. Very positively towards in the year that we're reporting, we progressed 2 candidates into full development. That means they're moving to the stage where we have high confidence that those projects will turn into products and get licensed to authorization to sell, and therefore be producing revenue in the future. So these 2 candidates we progressed were both mycoplasma vaccines in poultry. Mycoplasmas cause a range of disease in poultry, but in essence, it's a significant drag on production. They cause both traditional respiratory disease, but also economic disease such as thin eggs and consequently non-marketable eggs. These two candidates are targeted in the first instance. The first market will be the US. We are underway with a phased submission to the US regulatory authorities, which is the US Department of Agriculture for veterinary vaccines. That is quite a benign regulatory environment. And with this provision that you can submit as you go along, that helps us with the confidence because we're submitting each chapter as we complete it. You don't have to wait until the whole book of research and development is completed before submission. So this gives us good, strong indications, and we expect the first approval of the first of these two vaccines in late calendar 23, and the next one in early calendar 24. So that is useful and very helpful progress of our late stage pipeline. We're also undergoing, as part of natural business and part of my entry into business, a rigorous portfolio review to both manage and focus our spending to make sure that we're spending in the right way on the best projects with the highest value and the nearest term return. On the right-hand side, also wanted to briefly mention at the beginning, we gained with Avlacin in our therapeutic portfolio. Avlacin is still critical to invest in, and we gained a water-soluble license in China for poultry with a 0 egg withdrawal. This is important because it allows producers to treat at any stage of the production cycle without any concern of residues in the eggs, because Avlacin does not transmit into the eggs. And we got that license in China and last year, and we'll begin to elaborate that commercially this year. We also added a few bacteria to our respiratory disease claim in China, which helps to support our differentiation and support the commercial sales. As we exit or begin to progress things through the pipeline, and those will in the future exit, it's important that we refill the pipeline. And we signed 2 major research programs, partnerships this last year. Both we announced a few weeks ago in RNSs. One is mentioned here. This partnership we signed with Imperial College London. And this is a vaccine technology using messenger RNA. It's really next generation messenger RNA, similar in a way to the COVID vaccines in the human use of Pfizer and Moderna. But this is even another step on in the technology. AstraZeneca picked this technology up for use in the human side, and we've got the agreement with Imperial College to explore it on the veterinary side for elaboration for veterinary vaccines. We also signed a discovery project with Mordun just outside Edinburgh, a globally leading academic institution with expertise in poultry, and that was to give us access to a poultry red mite vaccine candidate. And so we're continuing to progress and track the development of a range of different candidates in a balanced portfolio. So really, really exciting portfolio of great value that we're beginning to get greater line of sight and give our investors greater insight to, which is what we're doing here. Next slide, please, Hannah. So a few operational highlights just to pick out. I think we've covered many of these. We've got the first license in China for laying birds with a 0 egg withdrawal. That's important because of the flexibility it allows producers. It's also important because China is a huge market for table eggs, the largest market globally, in fact. So this will help to support our business. And we believe that we've got continued great value for the producers. And with these additional claims, we add differentiation and we allow ourselves better opportunities to gain share and gain penetration. Mentioned that we've entered the swine market in Brazil, the swine vaccine market. We did a soft launch there of our partner vaccines in order to get our feet wet, to understand that. The revenue is small because it was late in the year and it was a soft launch, but it is strategically valuable. Also mentioned, just to repeat, we mentioned the vaccine candidates. We progressed into full development and we continue to drive the rest of the portfolio. Next slide, please. And final slide here is that what we see and what we're guiding for the future is that we expect the continued momentum in the major markets that we've shown 15% growth through March 22. We expect momentum to continue in most major markets, but we do see that there will still be some softness in China. So the rest of the world will balance off some of the softness in China. So we're guiding that we expect to trade broadly in line with the last year in most markets. Trading conditions are improving, and the seasonality as we go through the year also tends to support our business. So we see the recovery picking up later in the year and later in our financial year for China. So we're cautiously optimistic that the pork price that I shared with you and the inventory, excuse me, the supply and demand inventory changes globally in China will provide less headwinds, and those headwinds will back around and become tailwinds as we progress through the year into the second half. So the pork price, which looks nicely set, will help to underpin our growth in late 22 and early 23. And we are undertaking this product development review to make sure that we are spending correctly in R&D and in the right projects. And as part of my advent, we had an existing 5-year plan, and we are refreshing that 5-year plan. It won't be a significant change because the board and the business, I think, did a very nice job over the last few years in terms of identifying and deciding to invest in the preventative vaccine side of R&D. That's looking good, but it's a good part of diligent business. And as a new CEO, it's sensible to refresh that plan, and we're going through that process right now. We will be complete by year end. And as we and Chris has mentioned, we continue to execute cost discipline across the business to protect and support our business. So I hope by those slides and the comments that we've made, Chris and myself, that have given you an insight into this year. And I pass it back to Hannah if there are any questions, please, Hannah.
Which there are. So let's make a start. Do you envisage the market for Avlacin recovering to anything like the 2021 levels in the future, or should the current level be seen as more like the norm?
So we think that the 2021, particularly in China, was an exceptional year, and so that's 58 million revenue in China is a one-off and an exceptional rather than a target to be recovered to. If you recall the graph, we think that China is for Avlacin is around the mid to high 20s to low 30s in the future. The 58 is simply an exceptional year was an exceptional year for exceptional circumstances.
Thank you. What is the rough breakdown of sales between pork and poultry, both worldwide and in China? And is there a significant difference in profitability?
It's roughly 3/4 pigs, 1/4 poultry, varying a little bit between 2/3, 1/3, 3/4, 1/4, depending where you are. But that's the rough variance. It's slightly higher than that in China. So globally, it would be that in that 2/3 to 3/4, China will be a little bit higher into swine. And as I mentioned, the Avlacin water soluble is something that we can elaborate further to continue to develop poultry. We are selling Avlacin into poultry in China, and we have the ability, we think, to penetrate that market a little bit higher.
In terms of profitability, no difference. The cost of making a Avlacin for poultry is the same as the cost of making Avlacin for swine. Selling price is similar. Clearly, there's a difference in the volume used. And that is one of the primary reasons why the swine market is bigger than the poultry market. Not that there's more animals or less animals, it's about the quantity used to treat.
Thank you. Dividends from China. In addition to the 2.1 received from China from last year, you were hoping to receive another 1.6 before the financial year end. Has this now been received? And what else can you tell us about dividends from China in the current full year?
Yep. So that 1.6 was received. That was last year's dividend. and we're just in the process of finalising the dividends for this year. We hope that those will be received before the half year is complete, so before the end of September. Whether both of them arrive in time is questions about Chinese banking. But absolutely, those are in train and expected to receive shortly.
Thank you. What level of net margins are you targeting in, say, 3 years?
I think the group should be capable of 20% net. You know, the only reason why it's it might not have the kind of operational gearing that you might expect is because the R&D expenditure. And remembering that we've got a portfolio as reported this year, and for the near future, we expect that the majority of cash expenditure in R&D will be an expense item. So that will be a drag on net margins.
Next question is around resilience and the reliance on one supplier. How many manufacturing units around the world does the supplier have, and has supply been an issue over the last 2 years? Do you anticipate you'll be up and running with the new China factory, and will the is it anticipated that when it's up and running, I beg your pardon, and running the new China factory will export from China?
A number of points in there. So just to remind everybody as to how we manufacture, we're an outsourced business model, and that starts with the active pharmaceutical ingredient, the key ingredient of Avicin. That is an outsourced supply arrangement. We own the recipe, but we contract that to a production house in China that supplies all of the eco world with API. That API then is transported to a number of onward processing houses, one in China that we own. Elsewhere, these are contracted facilities, so contract manufacturing organizations, and there are 8 around the world that we are currently working with. They then take that API and process it on into finished product, and Avicin is then offered to the market in a number of different formulations. A mixed formulation, which goes into the feed mix, and a water soluble formulation, which goes into the drinking water. And then there are a number of strengths, a number of packaging sizes. And being a regulated product, once it is manufactured and released by a qualified person, that then is specific to that market, can only be sold in that market. So that is how we go to market and how we face. We feel that particular business model is a good way of both addressing the market and getting production close to the markets, as well as managing risk. And the question of supply concentration is obviously one which we consider very carefully.
And just on the last comment about the new China factory, it is on track. We expect that to be up and running by November. We've been monitoring that, and the shell is built completely. The equipment is going in as we speak, and we expect test runs next month and completion by November. So that has been on track and has not been delayed by any extraneous issues, COVID, lockdowns, whatever.
Thanks. Can you expand upon your understanding for the reduction of supply of pork? Was the sector affected by major unpredicted diseases, or is there a change that could also affect eco? So
the swine industry and the number of pigs has traditionally varied up and down. It's what's often referred to as the pig cycle. What has caused the number of pigs in the world to decrease, which I mentioned in all the major geographies, it's largely profitability. So as profitability wanes and eroded into zero and below in many regions, pork producers reduced the number of sows that they had on hand. They reduced the number of sows that they were breeding. That meant there was less piglets and less pork coming to market. So it was an economically driven effect. And that was really why. There was different reasons in different markets. So there was processing challenges in the US, processing challenges in the EU, and significant profitability challenges in China. But all of those were causing the numbers of sows to decrease, the global inventory to decrease, and the demand, as mentioned, continues to be strong. So that is the supply and demand equation.
Can you remind investors what the amount of cash held in the China JV?
It's around about £8 million.
And dividend, can you comment about the decision not to pay one in respect of full year 22? Is there an element of preserving cash in light of current economic uncertainties?
There's certainly an element of that. I think we're all looking to the future with caution. We don't know what cost inflation might bring. That said, that wasn't the primary driver in our discussions. The primary input was the investment opportunity around our new products. And so it's a balance between using the cash to progress as fast as we can with our exciting portfolio of new product opportunity versus obviously the benefits of providing a dividend. The decision this year was, of course, also influenced by reduced profitability. And so, putting all that lot together, the board's decision was to say, we're a growth stock. The opportunity set we've got before us in new products is really stronger, and I think delivers greater value to shareholders and investors rather than paying it.
Thank you. The three China companies, one's 100% and the other two 51% owned. Is the 100% owned company substantial, and who owns the new factory?
Okay. So this shows quite good insight. So the 100% owned subsidiary is indeed 100% of the group, 100% owned by the UK company, and it doesn't do very much other than to manage API. And API I talked about earlier on. It's the key ingredient of Avicen. Avicen, the API moves from the manufacturing house, the fermentation house, into that company and is then sold by that company to the joint venture. And that is a very important mechanism for us. It means that we control the intellectual property. It means that we control the supply chain, and clearly we capture some profit there. The profit and cash we capture there, we dividend back to the UK. The two 51% owned entities are both part of the joint venture. So technically, yes, there are two entities, but we always think of it as a single entity because one's a subsidiary of the other, and that is the JV that both processes that API into finished product and then sells it to market. The other really important reason for owning that 100% owned subsidiary, and it's a new subsidiary, it was new this year, is that allows us to do in-country new product development. So the vaccines that David was mentioning earlier on, first rollout in the States, followed by associated US markets, so the Latin American countries, followed by European countries, and then finally into China. China requires, before it grants a regulatory approval, it requires some in-country trials to be run. And having a subsidiary in-country owned by the group with cash in it allows that funding to happen much more effectively than if we were trying to fund it from the UK.
Thank you. Will the new products being developed have higher gross margins?
We expect that to be true. What typically happens in the animal health market is that biologicals, vaccines typically have a higher gross margin than what we're seeing with Avicin. So we do expect that. What range is a little bit TBD, but we should be able to be comfortably north of 50%. Exactly TBD will depend, because we're not making them at commercial scale, and as you do make them at commercial scale, you get operational efficiency, you get better yields, and the margin can improve as those yields improve. But it is a rule of thumb that biologicals, vaccines execute and enjoy a higher margin.
And I suppose that could sort of wrap into our last question, which is sort of on the lines of, if a few of your current investors are feeling a little jaded by the share price, what can they look forward to in the next 12 to 18 months?
Well, crystal balling there. I mean, there's reason to be jaded for across the market and indeed across our share price as well. I think that looking forward, you can see that the market isn't really giving us a great deal of credit for the existing business, nor really a great deal of credit for the future portfolio. And I think that's restrained by the overall market. And I think it's restrained a little bit by uncertainties that we've seen globally and uncertainties in the market in China. As we've tried to explain here, there's many reasons to be positive, many reasons to be optimistic around the producer profitability, which in the swine industry that supports our business, coming really down off record high, but now we believe, having reached the trough and coming up off the trough of pricing, so that should be supportive. And if the market values global revenue distributed across a number of geographies and a pipeline, then I think that is positive for the future for us and indeed for the market.
A good note on which to end. Thank you both, and we look forward to hearing from you at the time of your next results.
Thank you very much. Thank you, everybody, for joining. Thank you, Hannah.